Most retail investors think they're diversified because they own 20 different ticker symbols. In reality, they own one trade, long technology, long growth 20 times. In a normal market, the 20 positions seem to move somewhat independently and create the illusion of diversification. In a crash, when diversification is the only thing that matters, correlations spike toward one. Every position drops together, the diversification disappears, and the portfolio behaves like one massive bet on the sector. Today, the correlation math that defines real diversification, why correlations spike in crashes, and what actually protects a portfolio when conditions go bad. Here's the math nobody shows you. Diversification is defined by correlation, not by the number of positions. Two stocks with correlation close to one act like one trade. They move together, they fall together. Owning both adds no risk reduction over owning one. Two assets with correlation close to zero act independently. Owning both genuinely diversifies because one can rise while the other falls. The number of names you hold tells you nothing. The correlations between them tell you everything. And in crashes, correlations across risk assets historically spike toward one. The exact moment you needed diversification, the diversification disappears. Watch this in a synthetic crash. An investor holds 20 tech stocks, Apple, Microsoft, Nvidia, 20 different names. In good times, the portfolio looks diversified. Individual names sometimes lead, sometimes lag. Then a crash hits. All 20 positions drop together deeply, simultaneously. The portfolio loses 30% in 3 weeks. The diversification provided zero protection because the underlying correlation was near 1. 20 positions, one trade. The investor felt safe because they spread the risk across 20 names, but the correlations meant they were always concentrated in one bet. Here's what real diversification looks like. Different asset classes, not different names within an asset class. Equities, bonds, commodities, cash, possibly currencies or real estate. These tend to have low or even negative correlations with each other. When stocks crash, bonds often rally. When inflation spikes, commodities outperform. The classic 60-40 portfolio works specifically because of low equity-bond correlation, not because of name diversification within equities. The goal isn't owning many things, it's owning different things, measured by correlation, not by sticker count. Now with real diversification, the portfolio splits across uncorrelated assets, equities, bonds, commodities, cash, same crash hits. Equities drop 30%, but bonds rally as rates drop. Commodities stay roughly flat. Cash holds value and earns. Net portfolio drawdown may be 8 to 12% instead of 30. The recovery is faster because the equity drawdown is partially offset by the bond rally. Same risk capacity, completely different outcome. The reason isn't financial sophistication, it's just correlation math. Different things behave differently because they are different. 20 tech stocks behave the same because they are the same. In real practice, audit your portfolio. Calculate pairwise correlations between your positions using 90-day rolling data. If most pairs sit above 0.7, you have a concentrated bet wearing a diversified costume. If many sit below 0.3, you have genuine diversification. Add asset classes, bonds, commodities, possibly currencies, until your average correlation drops meaningfully. Position count is irrelevant, correlation is everything. Most retail portfolios fail this test badly and don't realize it until the crash exposes the concentration. So, diversification is defined by correlation, not by position count. Owning 20 tech stocks is one trade 20 times. Real diversification requires uncorrelated asset classes, equities, bonds, commodities, cash, measured by their historical and stress period correlations. Audit your portfolio for hidden concentration before the next crash makes the audit involuntary. Subscribe for the full method and trade your own plan. Education, not financial advice.